Brad Williams, Frugal Finance. Forward contracts with known income. In this section, we considered a forward contract on an investment that will provide a perfectly predictable cash income to the holder. Examples are stocks paying known dividends and coupon-bearing bonds. We adopt the same approach as above. First, look at numerical examples and then review the forward arguments. Consider a long forward contract to purchase a coupon-bearing bond whose current price is $900. We will assume the forward contract matures in 9 months. We will also assume that a coupon payment of $40 is anticipated after 4 months. We assume that the 4-month and 9-month risk-free interest rates continuously compounded are respectively 3 and 4% per annum. Let's say that the forward price is unusually high at $910. An arbitrager can borrow $900 to buy the bond and short a forward contract. Present value of the coupon payment is 40 times EXP 03 4 to 12 is 3960. Of the 900, 3960 is then borrowed at 3% per year for 4 months to be repaid with the coupon payment. The remaining 860.40 is borrowed at 4% per annum for 9 months, 3960, 886. The amount owing at the end of the 9-month period is 860.4 times, number here is 886.60, this compounding number. A sum of 910 is received for the bond under the terms of the forward contract. Arbitrager therefore makes a net profit of 910 minus 886 equals 2340. Let's say the forward price is currently sitting at a relatively modest 870. In this scenario, an investor has the opportunity to take a short position on the bond and simultaneously enter into a long forward contract. Upon shorting the bond, the investor pockets 900. Now, 3960 of the sum is set aside and invested for a span of 4 months at an annual interest rate of 3%. This move aims to ensure that it accrues enough value to cover the bond's coupon payment. Meanwhile, the remaining 860.40 is directed towards an investment with a 4% annual return spanning over 9 months. By the end of this period, it grows to 866.60. In accordance with the terms outlined in the forward contract, 870 is then used to purchase the bond, effectively closing the short position. Considering these moves, the investor ultimately comes out ahead, benefiting from the arrangement. 886 minus 870 equals 1660. The two strategies operate in opposite directions. The first yields profit from the forward price surpasses 886, while the second generates profit if it falls below that mark. Thus, in the absence of any arbitrage opportunities, the forward price settles at 886.60. Arbitrage emerges when the 9-month forward price deviates from the spot price of an asset that guarantees a known cash income. For instance, if the asset is priced at $900 and yields $40 after 4 months, with the respective annual rates of 3% and 4% for the 4-month and 9-month periods. Arbitrage opportunities when 9-month forward price is out of line with the spot price for assets providing known cash income. Assets price is equal 900. Income 40. Occurs at 4 months. 4 months and 9-month rates are respectively 3 and 4%. Here is the rundown of what I just talked about. Action now: borrow 900, 3960 for 4 months, and 860 for 9 months. Purchase 1 unit of asset. Enter into a forward contract to sell assets in 9 months for 910. Action in 4 months: receive $40 of income on asset. Use 40 to repay first loan with interest. Action 9 in 9 months: sell asset for 910. Use 886 to repay second loan with interest, and then profit 2340. Pretty simple, yeah? And then we have the second scenario where we're looking at forward price 910, action now, short 1 unit of assets to realize 900, invest 39.60 for 4 months and 8.60 for 9 months. Enter to a forward contract to buy assets in 9 months for 8.70. Action in 4 months, receive 40 of income, pay income of 40 on asset. Action in 9 months, receive 886 from 9 months, buy asset for 870. Closeout position, profit realized 1660. Can you remember all that? You need to be on the ball here in order to visualize this and be able to react within seconds. And with the advent of super fast computers, it's done all the time. But for us, if this is your life and this is what you do, you're a trader, this is what you can see and do, thumbs up. Brad Williams, Frugal Finance. Thanks for watching.